Next, we're going to talk about cost flow assumptions with inventory. In accounting, we have a few different options, and these are just accounting methods. They do not have to align with or mirror the physical flow of inventory. So another way to think about it is, for most businesses, they're going to sell the oldest inventory first, right? But our accounting of that doesn't need to match that. We're just talking about accounting for inventory. Sometimes it's going to match the physical flow, sometimes it doesn't, but nonetheless, we have choices from an accounting perspective. Depending on the method we choose, it's going to impact cost of goods sold, which is ultimately going to impact net income. And depending on the method we choose, it's going to impact our inventory valuation or the inventory cost carried on the balance sheet. So let's take a look at this situation from the handout. This one is E8-12. It says Twain Company was formed December 1st, year one, and the following information is available from Twain's inventory records for product BAP. I have this information on the board. I do. All right, so let's attach some dollar amounts to this so that we can get a handle on the goods available for sale, and then we'll go from there and pinpoint how much of those goods are going to remain in inventory and how much is sold. And again, that's going to differ depending on the inventory method that we choose. I'll try standing over here. We started, the period we're going to be looking at is the first quarter, okay? So our beginning inventory is 600 units at $8 per unit. That's $4,800. We made a number of purchases throughout the first quarter. On January 5th, we purchased 1,200 units. Notice the prices are increasing as time transpires. This is $9 per unit, which comes to a purchase of $10,800. On January 25th, we purchased 1,300 units at $10 a piece. That was $13,000. On February 16th, 800 units at $11 a piece, $8,800. And at the end of March, we purchased another 600 units. Prices continue to increase at $1,200 per unit. This came to 7,200 units. So right now, before we even consider the units sold, how much in goods available do we have? Units, we have 4,500 units available for sale. And this equates to $44,600. Let's do one more thing before we get into our first method, and this is to pinpoint how many units did we sell, because the exercise gives us our beginning inventory, our purchases, and ending inventory. So we know that the goods we have available for sale are either sold or they stay in inventory. So we have 4,500 units. We wind up with 1,600 at the end of the month. So I'm going to label this one's goods available. And this one is going to be, I'll call units sold. that comes to 2,900 units. This makes sense. We sold 2,900 out of the 4,500 we had, and that left us with 1,600 units. So let's start this off with FIFO. First in, first out. In other words, under this assumption, which kind of mirrors the physical flow of inventory. But if we choose this for accounting purposes, we are going to assume that the first inventory in, or the oldest inventory, is the first inventory we sell. We're going to answer 2 questions with each of these methods because this is ultimately the implications. What is cost of goods sold and what is ending inventory? I'm going to start each by calculating cost of goods sold. Cost of goods sold under first in, first out. We are going to assume that we're selling the oldest units first. That means we're going to assume that we sell the January units first. Remember, we sold 2,900 units. So I'm going to start with January. That's 600 units. $600 units at $8 a piece, $4,800. Since we sold 2,900 units, we'll move on to the next oldest layer, which is from January 5th. We will assume we sell all of these that we purchased for $9, and that was $10,800. Let's move on to January 25th. On that purchase, we wound up purchasing 1,300 units, but we got to be attentive to when we're calculating cost of goods sold, how many units did we sell? Right now, using these 2 oldest layers, we're at 1,800 units. So we sold 1,100 more, and we're going to assume we took those from this layer of purchases on January 25th. So I'm going to have 1,100 of those 1,300 units at $10 a piece, and this is going to be $11,000. So now we have the 2,900 units that we sold, and cost of goods sold under FIFO amounts to $26,600. So this answers question 1. Cost of goods sold under FIFO is $26,600. Now, we could, to calculate ending inventory, which is what I want to get to under FIFO, we could say, okay, I'm going to take this March 26th, do the math, the February 1st, we'll do the math, and then I'll take the 200 remaining that we didn't sell from this layer and do the math. That's going to give us our ending inventory. And you should do that to check your work. But we can think about it this way. If we have $44,600 of goods available for sale, and we sold $26,600, this leaves us with $18,000 in ending inventory under FIFO. Should we do LIFO?
Mm-hmm.
Go over here.
Mm-hmm.
This one's LIFO. Last in, first out. In other words, we assume that the last ones in, or the most recent purchases, are the ones we sell first. This may not match the physical flow of inventory, but nonetheless, we have this option for accounting purposes, and there's a number of reasons why a business may choose this method. So first, let's calculate cost of goods sold under LIFO. We're going to take the most recent purchases. This starts from March 26th. We had 600 units that we purchased for $12 a piece, and that was $7,200. We sold 2,900 units, so we are going to assume we sold the next most recent purchase from February 16th. That was 800 units at $11 a piece for $8,800. So now we're up to 1,400 units. We sold 1,500 more. Let's work our way to the next most recent purchase from January 25th for 1,300 units. We paid $10 for these, which was $13,000. Now we're up to 2,700 units. We sold 200 more that we're going to pull from this January 5th layer. And those units cost us $9 a piece. Cost of goods sold related to the January 5th purchase amounts to $1,800. So total cost of goods sold under last in, first out comes to $30,800. Same as FIFO, we could work out the math of what's left over, but we know that we had $44,600 in goods available for sale, and under LIFO, we're saying the cost of goods sold was $30,800. The difference must be the value that was left in inventory. And that's not going up. I'll do this over here. So ending inventory under FIFO will be our goods available for sale minus our cost of goods sold to arrive at $13,800 ending inventory under LIFO. We're going to use this board, and we're going to do the last inventory method, which is average cost. It'll be good to have all three of these methods on the board so that we can compare and contrast them relative to cost of goods sold, net income, ending inventory, income taxes. We'll have that discussion after average cost. Average cost method is what it implies. It averages the cost that we have incurred to purchase or manufacture inventory and applies that cost to cost of goods sold and ending inventory. So what is our average cost per unit? Well, we had goods available for sale of 44,600 units, and the units that were available for sale, 4,500. So on average, our cost is $9.91 per unit. So let's use this and we'll calculate cost of goods sold and ending inventory. Cost of goods sold under average cost. Well, we've got, and this is rounded, okay? $9.91 per unit. We sold 2,900 units. So this comes to $28,739 for cost of goods sold under average cost method. Now, if we know that we had $44,600 in goods available for sale, and under average cost, we calculated cost of goods sold to be $28,739, the remainder is left in ending inventory. So ending inventory under this method comes to $15,861. Let's talk about a few items. We're familiar with this, so I'm going to make that disappear. And let's look at these three methods: FIFO, LIFO, and average cost. Let me ask you some questions. Let's first just talk about the income statement. Which of these methods would net a business the highest net income? So what we're really talking about is cost of goods sold with that question, right? Which one of these methods nets the lowest cost of goods sold, which will ultimately give us the highest net income or gross margin? Our lowest cost of goods sold is FIFO. It's $26,000 under FIFO, $28,000 under average cost, and $30,000 under LIFO. And this makes sense, right? Because if we are using the first units, the oldest units, that would likely, and in this case it's true, have the lowest cost, because costs usually don't go down over time, they go up. If we're using FIFO, this is going to net the lowest cost of goods because we're pulling the oldest inventory and assuming we sell that first. How about the flip side? Which one is going to net the lowest gross margin or the lowest net income? Well, that's going to be LIFO, because we are assuming we're selling the newest, and which are the most expensive units first. So here, we're starting with this March 26th purchase, which was $12, and so on. This gives us a cost of goods sold of $30,000. Low net income seemingly isn't a great thing to aspire to, but the trade-off is income taxes are based on income, right? So here, even though we really have all the same costs, we're not changing what we paid for inventory, but because of the accounting choice we made, our cost of goods sold is higher, our net income is going to be lower, and therefore our income taxes are going to be lowest under last in, first out. Finally, let's just talk about ending inventory, because that's the other financial statement that we're concerned about, the balance sheet. For ending inventory, which method is going to net us the highest ending inventory? It's going to be FIFO. Why? Because we assume to sell the oldest units first. That means we also assume that the most recent units, the ones that have the highest cost associated with them, are staying in inventory. The opposite is true of FIFO, which we would assume have the oldest or least expensive units in inventory, and therefore LIFO is going to have the lowest value in ending inventory. Something to think about ending inventory is which one really resembles market value, because we can poke holes in any of these methods. For example, does LIFO represent the most accurate ending inventory if it's the oldest? Probably not. it's likely that in reality, the inventory that's sitting in the warehouse is the newest and most expensive. And we could ask the same question about cost of goods sold. But it's a few questions to think about. How does this impact the balance sheet? How does it impact net income? And how does it impact income taxes?